Okay, so in today's video, what I want to talk about is why most company cars aren't tax efficient, but also give you an understanding of the cars that are tax efficient in case you want to get one of those. Just remember, as always, if you find this video useful, remember to like, share, follow, and subscribe. And also, before I go into the video, I just wanted to let you know about our quarterly planning day. It's on Wednesday, the 21st of September, and it's a amazing opportunity for you to just network with like-minded business owners, really learn a lot more about business, and then put together a solid plan to actually move your business forward in the next quarter. It's a whole day, and if you want to attend, all you need to do is just get in touch with me, and I'll give you the details of how that event works and where you can book on. So what I'll do is I'll get into this video. So let's talk about why most company cars aren't tax efficient. So with a company car, you got a handful of things going on. Well, firstly, when you buy or lease the car and you put it through your business, that car is an expense for your business. So what does that mean? Well, it means you get a corporation tax saving. What does it also mean? Well, you're getting access to a vehicle without having to pay for it out of your own money, which means you also get a dividend tax saving. That's pretty good, right? And depending on whether you bought or leased it, you may also get a VAT saving. So that's like, the holy trinity of tax savings: the VAT, the dividend tax, and the corporation tax. But what a lot of people don't realize is there is a really big downside from a tax point of view to getting a company car. And that downside is called company car tax. You may have heard of it as P11D tax. And what the government says is, if you give a director or employee a car, it's treated as an extension of their salary, and it should be taxed as a salary, but with a slightly different regime. What does that mean in reality? Okay, well, so you've got all these tax savings for your company and yourself, which is great. But then the government's then coming back to you and saying, well, you've got a benefit as a company car, so we need you to pay tax on that benefit. And what happens is, most of the time, the tax on the benefit isn't based on how much that vehicle is worth. You could buy £1,000 old banger through your business, and you would probably be paying more tax than if you bought like a 40 grand brand new car with really low emissions. And the reason for that is the company car tax is worked out on the emissions of the vehicle. So it's not based on the value of the vehicle, it's based on the emissions. So if you're buying the kind of car that's pumping out a lot of CO2 and diesel particulates, then the government it is going to tax you an eye-watering amount. Typically, and this is just a really big generalization, but the tax savings you get by putting a car through your company, it might equate to like £2 grand a year. Company car tax can range from anything between 3,000 to 5,000, just on your average car. So in one hand, you're saving all this money. The other, you're paying even more than you're saving for the company car tax. And that's why, a lot of the time, if you've got some sort of petrol or diesel vehicle, you don't really want to be putting it through your company. You want to purchase it personally, assuming you've got the money available to do that. And then what you do is you reclaim the mileage rates on it. So you keep a track of the business mileage you're doing, and you just put in a claim to your business to reclaim it at 45p a mile. And that 45p a mile gets a tax saving. You might be thinking, well, what if I only do like 100 miles a year of business mileage? I'm barely getting any tax saving at all. And you'd be absolutely right to think that. But it's better to barely get any tax saving at all than to save £2 grand in tax and then pay an extra £3 grand where you've got a negative tax saving overall. So that's just one thing you do have to factor in. But if you have a petrol diesel car and you've got really high mileage, then actually by putting the claim in at 45p a mile, you're probably doing quite well out of it. So let's talk about the caveat to this. Well, diesel petrol cars are awful for company car tax. But electric cars are absolutely amazing for company car tax. So electric cars are where you get most of your savings, because the company car tax on electric cars is based on the CO2 output as well. So it's minuscule. The company car tax on an electric car might only be like £200, £300 a year. But you will still be able to put it through your business and get probably £2 or £3 grand of tax savings through it. So you're getting all the tax savings on that electric car, but your company car tax is tiny, and also there'll be some employers' national insurance to pay on it as well, but that's minuscule as well. So the electric car works really well. If you think about plug-in hybrids, that's what I've experienced with plug-in hybrids is sometimes you'll be lucky to break even, but usually you're not going to save that much. But with a plug-in hybrid, if you definitely don't have the money available yourself to go get in a car, but you want a good quality car that you can put through your business, then a plug-in hybrid might not be a bad option as well, but it just won't really be a tax saving. So really, I there's a lot more to this subject than I can say in this video, because if I make the video like 10 minutes, people like start writing in saying, hey, your video is too long. But one other thing I'll just like leave with you though is there's a difference between leasing and buying. So and there's also a difference between buying brand new and buying secondhand, because the tax treatment if you buy a brand new car is often different to a tax treatment if you buy a brand new, a second-hand car, especially with electric cars with the first year allowances. But one of the main differences between buying and leasing is, and sorry, when I say leasing, I mean like a contract hire. I don't mean like a hire purchase where it's essentially a loan and you get to keep the vehicle after. So yeah, when I say lease, it's essentially a long-term rental. But if you're doing a hire purchase, it's treated as essentially a purchase. So difference between buying and leasing, well, leasing, you can reclaim half the VAT. If you buy a company car and there's some personal use associated with it, then there is no VAT reclaim at all. Sometimes you get a much better deal just paying for that car up front rather than leasing it. So the better deal you get by paying for it up front can often counteract the VAT you're losing out on. But that's a consideration. And one of the other things to really think about is you might have chatted to the guy down the pub who says, okay, well, sorry, it doesn't have to be the guy down the pub, it could be anyone down the pub. And you probably chatted to someone down the pub who said, hey, you know what, all I did was designate that vehicle a pool car. Well, you could try and do that, but HMRC will figure it out. And you'd need to get business-only insurance. You'd have to prove that it was only kept at the business premises overnight, and it wasn't at your home premises. So it's difficult for you to prove that. So if you are using it for personal use, don't claim that it was for business only. So that's really the main thing. And there was one more point, but I'll save it for another video. So remember, if you found this video useful, just remember to like, share, follow, and subscribe. And if you've got any questions about it, just get in touch, and I'll be happy to help. So I'll see you in the next video. Thanks.